Hi there, welcome to kneppyinvests. In this group video of companies that did achieve an operational cash flow positive June quarter, I'll be focusing on four very diverse companies. One company is a small oil producer that has assets in Indonesia. Another company is a company I've never heard of before I started preparing this video. They do property development, that sort of thing. Another company that has been in indoor skydiving but has diversified recently into virtual reality and augmented virtual reality. And another company that listed in 2007, and when they listed, it was the largest IPO on the ASX for 10 years. And this company is the very definition of a company that has utterly and severely destroyed shareholder wealth. And that's the first company I'll be talking about in this video. And that company is Boart Longyear. Boart Longyear is sort of a mining services company that's been around for quite a while. In fact, it was founded in 1890. I do think the headquarters, if I remember correctly, the headquarters are in Salt Lake City or Utah, that sort of area. Now, even though it was founded in 1890, they only listed in 2007. And when they did list, the value of the company was well over $1 billion, and it was the largest or biggest IPO on the ASX for 10 years, and the previous biggest IPO was actually Telstra. So you can just see this would have been a significant IPO at that point in time in 2007. I believe Macquarie Bank handled the IPO at that point in time. Now, you didn't really want to take a part of the IPO and then keep your shares for the next 20 years, because if you did take a part in the IPO and just bought and hold your shares, you would have seen the value of your holding in this company depreciate significantly since then. In fact, I did some calculations. If you bought 10,000 shares when they IPO'd, those 10,000 shares would have been worth around $18,500. Now, in the past 5 or 6 years, they've done Boart Longyear have done two huge consolidations. The first one was a 300-to-1 consolidation, and the second one was 20-to-1 consolidation. So your 10,000 shares is now something down to something ridiculous like 1.7 shares, and those 1.5 or 1.7 shares is now worth 50 cents. So your $18,500 is now worth 50 cents. You want the complete opposite when you invest in a company. You don't want your 50 cents to turn into $18,500. You don't want your $18,500 to turn into 15 cents. So this has been a horrible investment for anyone who has held onto these shares throughout the last 20 years. The ticker code for Boart Longyear is BLY. Now, when you look at the market cap of Boart Longyear, which is 25 million at 29 cents, and compare that to the cash receipts for the half year and the operating cash flow for the half year as well, which were 1,416 million and 25 million, if you just look at those three metrics, you might think this company could be the cheapest company in the history of the world. When you have operating cash flow for a half year greater than the market cap, that should automatically raise some alarm bells, because that doesn't make sense. And the way it does make sense is when you look at the debt of this company. So at the half year, they had $916 million of debt. So in this sort of circumstance, looking at the market cap in isolation to get a true valuation of the company is absolutely wrong. You have to take into account the debt. So I use enterprise value to really gauge the value of the company. And when you do look at the enterprise value, so all you have to do is take the market cap, minus or add the debt, and then minus the cash. You get a number around $900 million. That is the true value of Boart Longyear right now. So when you compare the enterprise value to the cash receipts and operating cash flow, it does make a little bit more sense. So this company is operational cash flow positive, but they do have an enterprise value that is significantly higher than the current market cap. Now, that debt might be coming down because they were going through this restructure, and I'll talk about that restructure in the next slide. Boart Longyear have gone through two significant recapitalizations in the last 4 years. The first one was in 2017, and the last one has been this year. It's been driven by the debt. So they've had significant amounts of debt, which was putting this company under threat. And these recapitalizations have been highly dilutive to shareholders. Now, the first recapitalization, there was a consolidation, and the amount of shares at that point in time was $26.3 billion. So this company had been raising capital a lot. And when they raised capital, they had to increase the amount of shares. And it got to the point where the shares on issue was 26.3 billion. So they decided to do a 300-for-1 consolidation. And the amount of shares then decreased to 87.6. And then this restructure in 2021 was again because of the debt. And it was not good news for shareholders. And when we look at the chart in the next few slides, you can see the share price actually react to this news. So this recapitalization or this restructure would decrease the debt to less than $200 million, and $795 million of debt was going to be converted to equity. So the lenders were going to own 98.5% of the company after this restructure, and the current shareholders were going to only own 1.5%. And they decided to do another consolidation and decrease the amount of shares from 88.5 million to 4.4 million. And that 4.4 million shares is what the current shareholders were going to have in this new company. And the rest of the shares were going to be owned by the lenders. So again, really bad news for shareholders, but it was just because debt was really hamstringing this company. When Boart Longyear did list on the ASX, the IPO price was set at around $1.85 by Macquarie Bank. Now, when you do look at the chart, this is the monthly chart for Boart Longyear, going back to when they IPO, you might notice the share price back in 2007 is around $6,500. And of course, the share price wasn't that amount back then. What the chartists have done is they've adjusted the share price because of the two massive consolidations this company has gone through. And when you do look at the adjusted share price from back in 2007 and compare it to the share price now, you can see how destructive this company has been to shareholder wealth. The share price has fallen from an adjusted price of $6,500 to a current share price of 28 cents. When we look at the daily chart for Boart Longyear, and there is one reason I want to show you this chart, is because what happened in early January of this year. The share price started to run up before January the 7th. And it seems like some people might have caught some wind of some news in this company, some positive news. And we did see the share price rally. In fact, the share price tripled in 3 trading days. And then on January the 7th, the Boart Longyear announced the engagement of an advisor for a strategic review into the company. And the share price rose 70% on that day. So it seemed like the news of this strategic review was good for the company's fortunes. That strategic review lasted about 4 months. And then from the announcement of that strategic review to when they decided what they were going to do, the share price actually was falling, actually drifted down from a high of $1.20 to about 50 cents. And then they announced on May the 13th what they were going to do, or what the end result of this strategic review was, and it was a proposed substantial recapitalization, a consolidation of the shares, where the lenders were going to get 98.5% of the company. And on that day, the share price then dropped about 20 to 25% and has been dropping ever since then. Next company I want to talk about is ISI Group. ISA stands for Indoor Skydive Australia. It's been listed on the ASX for about 7 or 8 years, and it hasn't really been that successful. So what this company does is in the name of the company. They are or have indoor skydiving facilities, and because their activities hasn't been that successful in the past, they have diversified, and they have announced they'll be changing their name in the near future because they're diversifying into virtual and augmented reality. So the ticker code of ISA Group is IDZ, and that ticker code will also be changing. Market cap of only $6 million at 1.8 cents, and they have cash receipts of $8 million and were operating cash flow positive for the financial 21 year of 1.2 million. They also have a bit of cash on hand as well, 1.8 million. So if they do succeed in their new ventures, this company could be looking quite cheap at this point in time. Only 7 quarters of history for Indoor Skydive Australia, going back to just prior to the COVID-19 financial panic. We saw a bit of a dip during the peak of that pandemic when most states were locked down, and hence it does make sense why receipts did fell away during the June quarter in 2020. But it does seem like, just based off these 7 quarters of history, the cash receipts for the Indoor Skydive Australia stuck around $2 million. It is struggling to get any higher than that, but we only have a sample size of 7 quarters. And on the right is the announcement where Indoor Skydive Australia announced that they were going to change the name to X Reality Group with new ticker code. More than likely that ticker code will be XRG, more exciting ticker code than IDZ. This is the new XRG Group structure, and they do have quite a bit going on here, including maintaining their iFly or their indoor skydiving facilities. They also have Freak Entertainment. Now, they do have maybe 5, 6 venues right now, which Freak Entertainment is a virtual reality venue. I've never heard of it before, so it is expanding, and they do apparently have rapid expansion plans. The last one I did here was in Bondi. They also have one in Gold Coast, one in Penrith, if I remember correctly. In fact, I think one of the vertical wind tunnels is in Penrith as well. They've also have an enterprise vertical in regards to immersive military simulations and something called Red Cartel, which is virtual reality, augmented reality production, custom XR games, applications and software for in-house and external clients. As we turn our attention to this company's chart, over the past 18 months, just prior to the COVID-19 financial panic, when the share price actually of this company got down to 0.1 cent. The share price has been generally drifting up since that bottom in the share price during the COVID-19 financial panic. Now, there's not a lot of shares traded on a daily basis with this company, so there can be a little bit of volatility, but generally the share price is rising. The one thing I want to see with this company's shares is a little bit more volume coming in. And that would tell me the market is getting excited about this company. And I thought maybe that they're venturing into virtual and augmented reality. Maybe that would lead to a bit of an increase in interest from the market. It hasn't quite done that yet, but it doesn't mean it won't do that in the future. The next 2 companies I'll go through fairly quickly because I don't really want to discuss these companies at length because, to be honest with you, they're not that exciting. And the first company is BAS Oil Limited. This is an oil producer with assets in Indonesia. Market cap of only $8 million at 0.2 cents. And cash receipts, $1.8 million for the half year. And cash flow positive of $180,000. Not a lot of cash, only $203,000 of cash. But the main reason I haven't got much or have much of interest in this company is when you look at the chart. When we look at the BAS Oil's chart going back 11 years, this is the weekly chart. Nothing too exciting here at all. In fact, over the past 7 years, the share price of BAS Oil has been trading between 0.1 cent and 0.5 cents. And I don't really like to own companies when the share price is that low and has been that low for an extended period of time. And that is why I have no interest in BAS Oil. The last company I want to look at in this video is Hudson Investment Group, or I like to call them Game Over Man, Game Over. See if anyone picks up on that homage to one of my favorite films of all time. Now, Hudson Investment Group own and develop property and land, that sort of thing. Ticker code HGL. Now, the market cap of Hudson Investment Group at 24 cents is 14 million. And what I did find interesting is the valuation of their property is 35 million. That actually did raise my eyebrows because the market cap's 14 million, valuation of the property is 35 million. However, the debt is $11.5 million. You do have to take that into account. They don't have a lot of cash coming in. So during the June quarter, $410,000 of receipts, and they were operational cash flow positive, $185,000. But there is another reason why I have absolutely zero interest in taking a position in this company. When we look at the weekly chart for Hudson Investment Group going back to 2010, it might become apparent why I have no interest in taking a position in this company. It's simply because the liquidity in this company is absolutely shocking. The shares of Hudson Investment Group sometimes are not traded for months and months at a time. In fact, this year, there was not one single trade in this company in March or April. So that was a 2-month period where there was no trading in Hudson Investment Group's shares. And that's the main reason I don't care about this company at all, the liquidity or the lack of liquidity. That's all I have for this video, looking at 4 companies that did achieve an operational cash flow positive June quarter. If you do have any questions about any of these companies I did feature in this video, I'd love to hear your thoughts or your questions. If you are a shareholder of Hudson Investment Group or you just heard of them, I'd love to hear your opinion on that company, even BAS Oil Limited. I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.